Why analyzing fixed asset turnover ratio is very important. It is very important, especially in capital intensive businesses, because it is going to communicate what is the amount of sales that is generated by the business for every investment that is made in fixed assets. Because in capital intensive business, sales is dependent on the investments made in the capital assets, and if there is going to be a mismatch, then there will be a lot of expectation gap. Stakeholders will not be able to get good returns, and it can have long term impact. Let's understand that with an example. Look at here, I have two scenarios, scenario 1 and scenario 2. First, let's analyze the scenario 1. Here the sales is 100 crore and they are having a fixed assets of 200 crore. So what we can infer, for 200 crore fixed asset, they are making a sales of only 100 crore. So if I relate these two, that is, if I take sales in the numerator and fixed assets in the denominator, 100 by 200, what I will get is 0.5. I can call this as fixed asset turnover ratio, and what it communicates is, for every 1 rupee of fixed asset that is added in the business, they are making a sales of only 50 paise. And is it a good sign? Answer is no. Because when there is a lot of fixed asset added, on the other side, there are investors, there are stakeholders, there are lenders who have given the money for creating the fixed assets. So all of them are going to expect return on this 1 rupee. They have invested 1 rupee for creating the fixed asset, but this fixed asset is generating a sales of only 50 paise, and whatever the profit that generates will never match the expectation unless and until these guys are going to sell at exorbitant profit margins. Okay, so we have to compare these two and we have to arrive at this ratio, and here the implication is they are underutilizing the fixed assets. See, with 1 rupee fixed asset, they are making a sales of only 50 paise. It is a sheer case of underutilization. So let me give you another scenario, scenario 2, where the sales is 300 crore for fixed assets of 200 crore. So now if you calculate the ratio, fixed asset turnover ratio, which is 300 by 200, that is sales divided by fixed assets, you get the ratio as 1.5. It means 1.50 is to 1. So for every 1 rupee fixed asset, they are making a sales of 1 rupee 50 paise. They are making over and above the investment that is made. So people who have invested in this fixed assets will be expecting return on this 1 rupee, which has to be made out of sales and profits. But here the sales itself is 1 rupee 50 paise. So it is possible that it will make more profit, and that will match or fulfill the expectation of the people who have invested in the business. So here it is a case of better utilization of fixed assets. So it's very important to analyze this ratio to understand their efficiency in utilizing the assets they have created.